been really dramatic. It was only a month or so ago, right? We had like $18 silver. Now we're above 23. Um, why do you think there's been such a dramatic rise and very consistent? We really haven't seen much of a pullback since, since the $18 point.
Yeah, I think the rise has been sort of a confluence of different factors. So one of the big obvious ones is, what the Fed says. The second one, if we go directly to the gold markets, is the trade. December is always a big trade and delivery month for gold and silver. Now, most of the open interest on the COMEX derivative markets has actually moved off into February and into March for gold and silver, and so December's not such a big month. But we do see the last couple of days of the month previous, you can file your intent to take delivery of the metals. So starting about November 30th, and then the first couple of days of December, people can file their notice to take delivery. And we've had fairly substantial deliveries. We'll talk about silver here. We're up to 2,685 contracts of 5,000 ounce silver in the first 3 days. It's not overwhelming, but certainly a fair amount. Gold, we've had a little bit more. We're up to almost 12,000 contracts standing for delivery. And on the very first day, November 29th, that you could stand for December delivery, there were 6,100 contracts. So we've had some fairly robust demand for gold. The physical demand for silver deliveries on COMEX has been okay. It's been about middle of the road for this year. Certainly not, I think, what a lot of people have expected, but there were enough deliveries that I think it does affect people's view on the markets. I also think one of the big ones is FTX. So FTX and some of those exchanges and lenders in the crypto world are really experiencing problems. And with FTX in particular, it was basically like a multi-level Ponzi, because FTX would go in and look at players in the market that needed loans, and as long as they, had some cash and equity, FTX would loan money. And a lot of that investment went bad as the crypto market, crashed. I mean, we had 60,000 Bitcoin. Now we're down to a lot less than that. I think we just hit over 17,000 today at Bitcoin. So the market and crypto is not robust. That caused a lot of the exchanges to start to fail, especially if they were also lenders. And FTX in particular, every time they received money, they basically lent it out to Alameda, which then put it in a lot of risky investment. And that's essentially what happened. So FTX busted. And there's a lot of worries about repercussions from FTX. Is the contagion gone in the crypto market? Is there more? And I think that's rattled people because crypto's been such, a big part of people's investment and finance the last 10 years, especially the last few years. There's tons of money that went into crypto. And a lot of people credit crypto with maybe taking a lot of the funds away from the mining sector and from the gold and silver bullion. I think now that crypto's had, its sort of big liquidation moment this year, people are moving more of their money into gold and silver. And so we see very healthy demand from a physical standpoint. And I think if you add some of those factors up, along with, like I said, the consumer that's starting to flag a little bit here in the second half of the year due to the Fed interest rate rises, all of that really is pushing people more into safe haven assets. And I think that's why gold and silver are doing fairly well. Last thing I would like to say, we've been tracking the last couple of months, silver specifically, the bullion banks. And I consider the bullion banks pretty much to be the leader of the direction of where that's going to go, because they have the most data with their housing customer accounts. And they know what all the positioning is, and they really pay attention to the physical market. And the bullion banks have gone net long silver here for the last couple of 3 months. And so I think they're expecting the price to rise. And I think what that's done is to remove some of the short pressure off of that silver market. So silver's probably benefited, a little bit more than gold has. But both certainly benefit from the end of the year derivative trading. I'm sorry, I said last point, I have one more for you. The love trade. So India, China, a lot of that area of the world buys a lot of physical gold and silver this time of year for weddings, for anniversaries, for dowries, for a lot of celebrations. And so, and also a lot of people buy it at the end of the year for savings as they prepare for 2023. So there's been a lot of movement off of the Shanghai market in gold and silver deliveries. In fact, I believe in October, the Shanghai report had about twice as much silver deliveries on the Shanghai as you typically see in a given month so far in 2022. So definitely at the end of the year, people are not only going to COMEX in London to get their physical metals, are also going over to China. And I think that worldwide global physical demand is putting, is buttressing the price and putting a little bit of a floor here. And I think that's good. Gold is really challenging resistance points at 1800. Silver's popped through the $22 resistance point, which has been just so hard for it to stay above this year. And so those are all positive developments and from a technical perspective. And so I think that people should be very happy with what's going on in gold and silver. I think it's been great.
No, I was going to ask you kind of the forecast you have for precious metals going into the end of the year and further. We have a viewer question here about if we have a recession coming, possibly in the spring, how that could impact metals prices. Your perspective on that?
Yeah, I do think we're headed to a recession. If you look at the yield curve, it's been inverted for several months now. That usually predicts a recession somewhere between 6 and 18 months on average. It's done it 7 or 8 times in history that we've been following it. And the yield curve inversion is when you look at the 10-year bond and the 2-year bond. When the 2-year bond or the shorter term bond demands more yield, it means people are saying there's more risk right now than there is 10 years from now. That's backward from typical, because if you think about it, most people would think or assume that they're able to gauge risk 2 years out better than 10. So when you're demanding more yield and more risk in the 2-year time frame, it means we're expecting a recession. And if you look at GDP this year, the first 2 quarters were negative. I think we had a negative 1.6 and a negative 0.6. Now it looks like GDP for third quarter was positive, and it looks like for fourth quarter it's trending positive. We had some data out on that this week, so it's not a lot though. If you decrement it for inflation, you're really not growing all that much. So, it depends on how you slice the numbers. Statistics are wonderful. You manipulate them however you want. Net of everything, cost, inflation, everything, we're not growing right now. In fact, we're probably shrinking a fair amount. And so I think from a nominal perspective, we're in recession right now? No, but from a real perspective, when you talk about interest rates and inflation, yes, we are. And so I think we're already there. But I also, if you look at what's going on with a lot of the analysts, Bank of America, Goldman Sachs, these guys are coming out with reports that say things like, we expect rolling shockwaves to the economy in 2023. We expect a worsening depression. Some of the big commercial banks, global commercial banks now that do business in the U.S., they're not U.S. based anymore. A lot of those banks are basically saying, yeah, not only are we going to have recession, but we're expecting some fairly big volatile movements in the economy. It's going to go up, it's going to go down. And when you get to that point, Elijah, what that's signifying is stresses in the economy leading to something bigger. Think about it as like a pre-shock to an earthquake. Sometimes you get the little baby shocks and then you get the big one. And I think what's happening is we're seeing the baby shocks right now with data we've seen in 2022 with GDP and inflation and the Fed having to react with raising the federal funds rate. But I think the big one's coming. And if you listen to some of the big commercial banks, they think 2023. That's entirely possible. I mean, it could happen. We'll just have to kind of stay tuned to the economy for any big shocks that come. A big bank failure, one of these sovereign national economies really suffering from higher inflation, say more than double digit. We see somebody get, a pretty big size, get into like 20 or 30%.